Hello, in this video, I am going to discuss gross domestic product, explain the two approaches to determine the GDP. I will then, make few adjustments and show you other measures of a country's total output because GDP represents the total income of a country. So look at the definition on your screen, the total market value. By market value, I mean you have to value each good or service and service using its current price level of all final goods and services. By final, I mean all goods and services that are ready for use. I will exclude all intermediate goods or raw materials produced in a period, normally 1 year. So GDP is always represented attached, represented using a time period as well. So for example, GDP of country X is $1 trillion in 2023. So time period must be attached as your income. So normally you report your income per week, per month, per year, etc. Within a country. So all those goods and services that are being produced within the boundaries of that country will be included in this measure. Economists use enormous amounts of data to determine the GDP, including information from hundreds of surveys completed by businesses, the government, and households. So we basically compile all these surveys and they, of course, data, and then come up with just one number. Just one number. So let's discuss these two approaches succinctly. So one approach is, as I mentioned earlier, the expenditure approach or expenditure method. In this approach, we add all these four expenditures categories: consumption expenditures, investment expenditures, government expenditures, and net exports. By net exports, I mean exports minus imports. So net exports means basically exports net of imports. Remember, these are four different expenditures categories. These are not different types of commodities or goods. For example, if I buy a truck for my own use, that is consumption expenditures. If an investor buys the same truck, exact same product for his or her own business, that is investment expenditures. If government buys that same truck, that is government expenditures. And if a foreigner from another country buys the same truck from our country, that is exports. So the same product can be classified any of these four different categories. So if we add all these expenditures, we get GDP. Similarly, we can use the income method to reach to the same conclusion. That is, you get the same number using income method. But there is a problem calculating GDP using income method. Why? Because we have to make two adjustments. Let me give you a simple example. So for example, if I buy a computer for, let's say, $1,000. When I buy, this is my expenditures. And suppose if I'm buying for my own use, that is consumption expenditures, and I'm spending $1,000, that $1,000 will be added to the GDP of that country. But this 1,000 is not the income of the producer of this computer. Why? Because this 1,000 includes sales tax. This 1,000 also, that is the price, actual price, apart from sales tax, will also include, actually already included other taxes. That is what we call taxes on production. For example, payroll tax, other government duties, taxes. So the producer of this computer will receive income 1000 and then subtract both taxes, that is taxes on production and taxes on products. After excluding those two taxes, that would be the income of the seller. So in order to get the same answer, we have to make these two adjustments. That is, we have to add these two taxes again to the incomes of those sellers so that we get the same answer. So now let's discuss three different income categories. Number one, compensation of employees. By compensation of employees, I simply mean wages and salaries, bonuses, etc., etc. So if you are employed and you are earning income, that income will be included as compensation of employees. The second category is gross operating surplus. So this is the gross output less the cost of intermediate goods less employee compensation. So if you're running a business, incorporated business, right? So that business will earn after paying the cost of raw materials and paying all wages and salaries, whatever is left is the gross operating surplus of that business. That is second type of income. The third type of income is gross mixed income, is nothing but the income of self-employed people. So self-employed people's income is what we call gross mixed income. So we add all these three incomes and then we make adjustment. We add taxes, of course, net of subsidies. That is, we are subtracting already subsidies on production, for example, payroll taxes, and then indirect taxes on products and imports, net of subsidies, for example, goods and services taxes, GST. So we add these two types of taxes to these three incomes, we get the exact same answer as we get using expenditure approach. So these are the two methods that we use to calculate GDP. But you know, GDP is not the, does not cover everything, right? So GDP is not a complete measure of any country's economic progress. So there are a few or some problems when we measure GDP because sometimes GDP does not measure everything. So these are some of the activities that are not included in GDP. Number one, intermediate goods, because that is the definition. The definition says final goods are included only, not intermediate goods. Sales that merely transfer ownership. You know, if you are simply transferring the ownership of anything, you are not producing anything. GDP has to do with the total production of the country. So that will not be included as well. Public and private transfer payments. I told you transfer payments in one of the videos that transfer payments are just one side payment, right? You are not getting anything in return. So there's no production involved. Second-hand goods. I said current production. So all those goods, for example, if I want to calculate the GDP of 2023 of a country, then I have to add all those goods and services that are produced in that year, 2023. We can't add the production of goods and services in year 2022. So if you are spending money on products that are being produced in 2022, will not be included in this year's, that is 2023 GDP. Underground activities also are not included. Illegal activities and unreported but legal activities. And the reason is same, because you can't value those goods and services. Those are not reported, unfortunately. And this is one of the major problems with many developing countries, non-market activities. So sometimes what happens that in some of these countries, production is taking place, but there's no market for those products. So you can't add in GDP measure. For example, you know, if someone in the house is doing his or her own work, of course, if you had hired a maid, then you would have paid to some money to that maid. That money would be the income of that person will be included in GDP. But since you are doing your own work, there's no market activity, and therefore those activities cannot be included. That is do it yourself production. In many developing countries, people are providing these services without any market price attached. So you can't add volunteer services and services of homework. These are not included in GDP. Now, this is the summary of other measures of a country's total output after making certain adjustments, right? So I use the red color just to show that how I change or make adjustment. So we started, let's start with gross domestic product. You all know what is gross domestic product using expenditure approach. So I'm using this expenditure approach at market price. By market price, I mean current price. And current price, remember, includes sales taxes as well. So if the sales tax is 5%, and if the price is $100, then I'll pay $105. That is the meaning. So $105 is my expenditure at current prices. So using expenditure approach, if I want to calculate GDP, I just add these four expenditures categories. That is consumption expenditures, gross investment, government expenditures, and net export. That is exports minus import. Now, if I want to change this measure and make these adjustments, suppose a country is producing many goods and services in that specific year, but at the same time, the tax rate is very high, and also there's a lot of depreciation as well, right? So if you want to add these two or adjust these two factors, we end up or we get a new measure. This is what we call net domestic product. So if you notice, I wrote net with a red color. Why? Because now I'm comparing gross with net. So that is one comparison. Gross means you have not actually subtracted depreciation. This is the meaning of gross. If you subtract depreciation, that is called net. So now if you take the other component, here I wrote net domestic product, NDP, at basic price instead of writing current market prices. Sorry, this is not market, this is current prices. Basically, market prices means current prices, but I'm writing here. So current market prices, right? So this is basic prices. By basic price, I mean price without these taxes, without sales tax, basically. This is basic price. So if I want to calculate net domestic product at basic price, it's easy. First, I calculate GDP at current prices, that is market prices, and then I subtract depreciation to get net from gross to net, and then I subtract indirect business taxes. Sales tax is one of the examples of indirect business taxes. I get net domestic product. Now, if I change from net domestic product to net national product, so notice now I am changing from domestic word to national. The difference between domestic and national is, by domestic, I mean it doesn't matter who are producing those goods and services in that country, will all be included in the GDP. So for example, if an American who is working in Nigeria, so the American's income in Nigeria is included in the GDP of Nigeria. Doesn't matter who are producing those goods and services within the boundaries of Nigeria. So if an American is working, an Italian is working in Nigeria, his income will be, or her income will be included in the GDP of Nigeria. By national, I mean what is the total production of goods and services produced by the nationals only, by the citizens, Doesn't matter where they are residing. So for example, if an American who is working in Nigeria, his income will be included in the GDP of Nigeria, but his income will also be included in the GNP of United States, national product, not domestic, national. Since he's an American, so his income will be included in the GNP of USA. So this is the difference between domestic and national. How we are going to convert or move from net domestic product to net national product. So this is the formula. So net national product, that is NNP at basic price, is equal to NDP at basic price. So first we take this same NDP, and now I have to convert. So I have to make adjustment. This is the adjustment. What I'm going to do, I've already calculated NDP at basic price above. Now what I'm going to do, I will add the incomes earned by Canadians outside of Canada. So let's assume that I'm taking the example of Canada, right? So otherwise, country X would be difficult if I write X and Y. So I just take an example of Canada. So suppose this is NDP of Canadian economy. That is whatever is being produced within Canada, doesn't matter who are producing, will be included in the domestic product. Now, if I want to convert from domestic to national, what I have to do? I have to include all the incomes of Canadians who are working abroad. So this is income and, sorry. So income earned by Canadians outside of Canada. We have to add. And we have to subtract all those foreigners who are working in Canada, because their income will not be included in the national product. Domestic product is fine. So we have to subtract income earned by foreigners who are living within Canada, in Canada. Now, rather than writing every time, all the time, these two, so if I take this whole, that is income earned by Canadians outside of Canada minus income earned by foreigners in Canada, we call it net foreign factor income. That is net foreign factor income, NFFI. So net national product, NNP at basic price, would be NDP at basic price, and we just add NFFI, whatever be the number. It may be a negative number if foreigners in Canada are producing more than Canadians who are living outside Canada. Then we have a negative number. It may be a positive number if Canadians who are working abroad are making more money compared to foreigners in Canada. Now, so I gave you this example and I get three different other measures after making these adjustments. So the other measures are net, just give me a second. This is, yeah. So net domestic product, net national product. So by just adjusting, I can get these two more measures of economic, basically, activity in the whole country, for the whole country, not just for one sector. Now, I can do the same thing using income approach. The only difference between income and expenditure approach, you will have the same formula. Everything is same except one. So, and that is not also necessary, because if you have already mentioned income approach, then you don't need to make this this distinction. But normally, what we do, instead of product, we just write income. So instead of P, we just write I. Doesn't make any difference. So there's no difference between GDP and GDI. The only difference is that you have used two different methods to calculate. So GDP is GDP using expenditure method, and GNI or GDI, that is gross domestic income, is using income approach. So if I show you this last slide, you will see here that everything is same except I have written gross domestic income instead of gross domestic product. The formulas, all formulas are exactly identical. The only difference is I am just writing uh, uh, income. And one thing, let me emphasize again, by market prices, I mean current prices. Okay, don't get confused with this. So by market prices, this market prices, I mean current prices, and this is basic prices. So the difference only is indirect business taxes. Thank you so much.